Hey everybody, it's Ed Zoller, Villa Realty Group. September is done, which means that we're going to go over another market update about what happened in September as far as the real estate market in Southwest Florida. For those of you who don't know me, I've been a real estate agent over 20 years, full time. I do market analytics. I compose of graphs, data. My mission is to educate buyers and sellers so you guys can make more informed decisions using the data in this PowerPoint. Now, you're going to have access to this at leecountymarketupdate.com. You'll be able to see every single update I've done right now since January, but I've been doing these pretty much since 1999. I stopped doing them in 2016 because when markets are boring, markets are boring. Anyway, I'm going to make this video short. Let's move on to the data. So September, big news. The Fed's cut the rate 50 basis points. For those of you that don't know what that means, it's 0.5% off of the short-term rate. That does not mean mortgages go down. That means that the interest rate that the banks lend to other banks went down 50 basis points or 0.5. Rates are still over 6%. This is what people don't get. But they're not 7, 8% as they were literally 1 year ago. I think they were at almost 7%, and now they're at 6. So it is a 1.5 down. It was 7.5 last year and 6 now. So that is a lot better. It's a step in the right direction. So what happened in Southwest Florida? Our inventory went up. This is weird because September has always been our launch pad. From when September happens, it goes up. And in September, inventory goes up, goes up, goes up. At least it has since 2016. And it goes up like 3,000 homes. That was 3,000. That was a little less than 3,000. This was exactly 3,000. COVID happened, so it really didn't see where that went off to. But August, we went up. That hasn't happened in a very long time. So this is something to consider. Our long-term average of inventory is about 6,500 homes. If I go all the way back the last 10 years, we're at 93, almost 9,400 things that you can buy out there in Lee County. That's 5 cities worth, North Fort Myers, Estero, Bonita Springs. And if we're going to start going up 3,000 from here, then it's going to be off my graph. I'm going to have to make the graph, I'm going to have to change my graph out. So 12,000 is not the peak. That more inventory means better deals for buyers out there. I did tell you guys since January, September to January is the perfect time for buyers. We're just hitting into September, October, November, and December. These are when we're going to have more increasing inventory. Sales should be going further down, which means that you're going to have more to choose from. So kind of weird that it didn't happen in September as it has almost every single year, except for, of course, these garbage COVID years. Our demand actually ticked up. I wouldn't say gaining 10 more sales in a month is a huge uptick. The big concerning for me is look at this downward trend of these peaks. Just down, 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 down since 2021. We expected that. Things are not affordable right now as they were back in, prior to COVID and all that FOMO buying that was happening in 2021, the actual real peak of our sales. But if I go back to the lowest sales we've ever had in the last 40 years, it is kind of funny that the number 1, 2, and 3 lowest sales are happening in all this year. January was our lowest. Number 2 is last month, and number 3 is the month of September. So decreasing interest rates may cause this number to change. We will see. But as far as graphs go, we aren't expecting to see any kind of increase in demand until January, as it has these last 4 years. So that means that this will continue to either hover or go back down. You'll see this happen in 2022. It didn't really go down during those months until it hit January and then lifted off. So we'll see what happens with this, but there's something to make note of. The average home price is one stubborn thing. Look at how smooth this last crash was in 06. I mean, a little up and down, but look how, rounded that thing is and how the rounding down here is. But look at this. It's up, it's down, it's trying to go back up, trying to go back down, and it's jagged. Now, it did go up 0.7%, which it went down last month 0.7%, so it really hasn't changed from 2 months ago. So when you're having decreased sales, record low sales, and increasing inventory a month before it was even supposed to increase and increase another 4 months, you would have thought this would have been lower. But remember, builders out there are keeping prices elevated and offering incentives. Instead of back here, they just dropped their price 10 grand a month. That's what was pretty consistent that I could say that I remember back in 06, 07, 08, is it was almost like every single month down 10 grand. This is just one little stubborn thing. And ultimately, we want to get this down here. This is when I believe we will stabilize. When you see average home price, and this will be upticking because you can see here this little slow train. I'm going to keep doing that with this magic arrow here. That's where we should be. We should be, our average home price should be slightly above $250,000, and it's $125,000 over elevated based on current conditions. Just something to consider when you're looking at this graph. So average home payment. Now this, as a percentage of income, and this is an important graph. This factors in everything. Property taxes, insurance, interest rates, average home price for the month. It divides that by the median household income of the county, and it comes up with a percentage of what is affordable. We can say here, this line, anything under this line here is what people would call affordable housing. Anything under 30% is what the books say, but as far as Lee County goes, 26% is affordable. That means 26% of your gross income goes towards a mortgage. Now we went down. We've been up in the 40 percentile range forever, just like we were in forever in the 40 percentile range here. And then in 08, we kind of dropped into the 30s. And look at what's happening here. We overshot affordability. It is not sustainable above here. It is sustainable below this line or at that line. So we still have a little bit of a gap here. But the good news is it went from 41% to 38%. And why was that? Because interest rates from 1 month ago were at 6.675, and now they're at 6. So the interest rates went down on their own prior to the Feds even doing this. We did have a slight uptick in home price, but here's big news. I don't know, I haven't seen this in over a decade. Our average household income went down. It's always gone up 50 bucks, up $100. It went down $2,000, a drop of 3%. And I'm going to try to explain, because I tried to find data that supports why this happened. Is this just a fluke? But you can see here, when average income goes down, even though affordability went down, people can only afford now, based on this number, about $1,500 a month. Or last month, they could afford $1,620 if I just take that average. So doing this math here, I'm going to try to explain why this is and why I think it is and what kind of data that can support this. But when we always say interest rate is everything, yes, it is. But income is more important than that. If income's dropping, they'll afford much less, much bigger impact than just what price can handle. Moving on to the next one. Average growth month over month. I only use this graph to look at stabilization. Hey, Ed, are we stabilized? Yes, no. Are we below this line or above this line? If we're stable, we'll be at the line. That is a stable market. And if you're above the line, it's an actively going up market. If you're below the line, it is going down. The further from center you get, the worse off the market is. I actually tracked the consecutive months that we've been under this line. Last time in 05, 06, and 2007, we went 59 consecutive months of negative growth right here until we stabilized right around 2011, 2012. We are at 14 consecutive months now of negative growth. It did uptick a little bit. So it went from 0.76 to 0.68, but it's still a negative. And if I look the last time we were 0.68, other than the month previous, you kind of see it's really never hit that line except for right here in 2011. So we'll have to see next month and keep track of this. But if someone asks me, is the market stable? Hey, I look at home value growth month over month, and if it's at center line or 0%, I would say it's stable. We're not. We're under that line, so we are not stable yet. Our price cuts we're getting really close to this long-term average of 22%. And you can see here, we have peaked before in the 30% price reductions. This takes the total listings and how much percentage of people drop their price. I think the memo's out. From 6 months ago when I was doing these updates and sellers just weren't getting the memo that the builders were dropping their price and that their house was not worth what it was last year, I think people have gotten the hint now. So our price cuts, people are actually going on the market priced more to sell than they were, let's say, a year ago or 6 months ago when they still thought that they were sitting on gold. They're not sitting on gold because the market's dropping. We are in a downward trend. which means that next month the house will be worth even less, and next month the house will be even worth less. So the price reductions aren't as rapid as they were here in the towards the middle and beginning of the year. But we are still above this line, which anytime we're above it just means that there's a little bit of chaos. Not as much as there was, but this is a good step in the right direction. Still higher than where we want to see it at 22%. So let's just compare the stats here. Last month and this month. So up on September 1st, we had 9,164 homes. Now we have 93. It's up. The single-family homes sold, they went up 13 more homes than last month. That's a good step, but definitely not up to our par of 1,900 or 1,800 homes that we normally sell on the average. Our pending sales, this is future sales, went down. Our new construction, even though the builders are offering $50,000 to $100,000 with incentives, they're still gaining more inventory. And as a matter of fact, nationwide, builders have more inventory now than pretty much back in 06. 9.7 months worth of inventory. There was times we hit 11 months, but 9.7 has only happened a few times. People who've watched my previous updates, you've seen that graph before. It did go up. Average time on market went down because I believe that owners are finally getting the hint that their house isn't worth as much and they're going on for a more accurate price. The median asking price went down 10 grand. The median selling price went down about 10 grand. And our asking price to sold went up a little bit. This is going to always hover between 96 and 97%. This is also just looking at this month's low sales. So a sale has more strength towards this of if they sold for full price or not. But this number will keep going up as long as owners go on the market for a more reasonable price. And they'll probably sell for that price. So overall, it kind of a stalled market. The affordability is ticking closer than we've seen in over 4 years, but still way off from where it wants to be. But all these bullet points still tell me this is a buyer's market with increasing inventory, record low sales, and at prices that are going down. Moving on. Here's a new graph. I love my graphs. Anyway, this is interesting. If you take the salary you need to afford a home, let me explain how I came up with these numbers. Right here, this little gray graph is the median income for Lee County. And you can tell that we did go down in 2020. We all know why income went down in 2020 because of COVID and unemployment. We also know why this went down because we had our financial crash and unemployment went up. So anytime this graph has gone down since 05, it's only gone down here and here. Income-wise, and I just told you from this month, we went down a little bit. Not enough to call that a trend, just 1 month. But if that becomes a consistency where it's income's going down, probably means, this is more explaining that unemployment might be a factor for that. As the household income that you need to comfortably afford, the books say if the household spends 30% of their income on their total house payment, that is affordable. So I took those numbers. And what I realized here is you take today's price, today's interest rate, today's insurance and taxes on the average home, and you say, what kind of income do you need to make to keep that 30% static? And obviously, it's going to have different numbers. I want you to look over here first. I did the difference, just on drawing arrows from median to actually reality. And you can see here, we are way above what actually people make down here. This is another way of saying that we are not affordable. Then I took these little arrows and I duplicated them to see last time we were this far apart. Well, it was between 2007 and 2008. But look at the difference between what you needed to make and what actual income was here. And I put that same arrow here. So I could sit there just by those arrows alone, tell you that we were more unaffordable in 2023 into 2024 than we ever were, including 2006 and 7. Some say that means that we might crash farther. Others will say it's a different time, different reason, different place. I just thought it was interesting that I could make that statement and have this data to back that up to say that from what I'm interpreting here is we went up way beyond what people can afford. We were more unaffordable this year or last year than we ever were since 2005, including the market bubble of 2006. So I thought that was kind of interesting. Either way, it doesn't stay up above this line for long. You can see how long, from 2009 all the way to 2022, that is a decade plus that What you needed to make is you could actually afford the home. And then obviously for a few years we went way above because of COVID, and it's on its way back down, just like it was right here. So buyers or sellers market. Some people are confused about this graph. What I did was I took 3.9 months of inventory. This is what my definition of a buyer's market is. Anytime we hit over 3.9 months of standing inventory, that is a buyer's market. There's more inventory than there are buyers. And I can put that in a category: slight buyer's market, a moderate, and extreme. I don't even know what to name that. Crazy, stupid buyer's market. And obviously for normal seller's market, just one deviation from that line, and the next one I would call that extreme sellers. And sellers, you had your time. 2021, 2022. This is when we had no inventory, which means you were rare. But look at here. We are almost to the threshold. We are in extreme buyer's market zone, almost making our way towards here. If that inventory, guys, goes up to 10,000, 11 or 12,000, and we still have these record low sales, this thing is going to go off this chart. And I'm going to have to name more categories and zones. So if you ask me, buyers or sellers market, this graph tells us exactly where we are. We are in an extreme buyer's market. Buyers are making up the rules. If you're a seller who wants to sell, but you're going to have to cater to these buyers. So I'm going to talk about the Fed rate cut. This is going to go along the line of why I think the average income went down. All right. What I did was I took from Fred this graph, and what it shows is as the Feds have cut rates historically all the way since 1955. Now bear with me here. The shaded areas, this little gray bars here and here, indicates we had a U.S. recession. And I thought was kind of interesting. When the Feds cut the rate in 1953, we had a recession right afterwards. I wasn't even born yet. We had a rate cut in 1957. We had a recession. We had another recession with no Fed rate cut. That happens. We also had a Fed rate cut in 66 and no recession. Look at unemployment. This red graph here is unemployment numbers as a percentage. And you can see where these spikes happen. So I'm going to keep that in record. Then we had a rate cut in 1970, immediately followed by a recession and a spike of unemployment. We had a rate cut in 1973. I was born by now. And we had a recession. We had the double dip, 2 rate cuts in 80 and 81, and we had 2 recessions. It's called the double dip recession. You can see how high unemployment was then. We had a rate cut in 84, no recession. 1990, we had a recession. 1995, we didn't. 2000, we did. 2007, we definitely did. Much thicker recession. That was the big bubble crash. We had one in 2000. Couldn't call that a recession. Oh, I'm sorry. We did have a recession. We had a rate cut in 2019, had a very small recession. Of course, we know that's the COVID recession. And we just had another rate cut. So that means 10 out of 13 rate cuts indicates that we have had a recession. So 76% of the time the Feds cut the rate, unemployment has skyrocketed, because you can see here, every single recession, the unemployment skyrockets, skyrocket, 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 skyrocket. And we hit a recession because of that. Unemployment indicates recession, not a Fed rate cut. But Fed rate cut usually is an indicator that shows that unemployment is getting ready to spike. And we are on this little uptrend here. Here's what I found really interesting. When you take the 3 years, 66, 84, and 95, that the Fed cut rates and we didn't hit a recession, something that was interesting about those years is that the year-over-year unemployment increase never hit higher than 4%. That means from one year to the next, when they did that rate cut, the unemployment had not upticked up more than 4%. But right now, and 10 out of 10 times that we have had a Fed rate cut and we've gone into recession, we had a year-over-year increase of unemployment of over 20% or more. Right now, last year to now, we went from 5.9 million unemployed to 7.1 million unemployed. That's a 21% increase. So will history repeat itself? Is this enough data to say that we might have a recession? I don't know. But it's interesting data to say that 10 out of 13 times the Feds make a rate cut, we crash. But 10 out of 10 times, and we are over 20% year over year, they've crashed, and right now we are at 21% year-over-year increase of unemployment. I thought that was interesting data. Does this mean a recession's coming? We don't know. But indicators are, historical indicators will show you that, right now we are 100% likely that we will. just based on the previous 10 times it's happened. 10 out of 10 has happened. So will this be 11 out of 11, or will this be the, oh, it didn't crash. Look at that. I don't know. That we'll have to just see what happens, but I thought that was fairly interesting. And that might explain why average household income went down $2,000, because more people are collecting unemployment in Lee County. There's no way of tracking that. There is eventually, but I will not be able to catch that data on a week by week or month by month basis just yet. It is data I'm going to be searching for and trying to get, but I think that's interesting. So let me just give you a quick overview of September. Inventory went up, demand went up slightly, pending sales decreased. That's not good for future sales. Unemployment upticked in the country, in my opinion, make household income go down. So if that continues, then we're going to see that worse. The Feds did cut the rate 50 basis points. And like I just showed you, 10 out of 10 times we've had a recession when the unemployment year over year was over 20%. And the 3 years that it didn't lead to a recession, year over year unemployment was never more than 4 or 5. So I thought that was interesting stuff. Hopefully this is interesting kind of stuff for you. Of course, all my data, you can copy, screenshot this, go look at any of this. Obviously, BLS.gov, Federal Reserve Economic Data, our local board of realtors, realtor.com, of course, Zillow. The Reventure app is a great app that's out there right now if you want to Google that and find out where that is. I get a lot of data sources. Obviously, I want data right now so I can help interpret, make my graphs, and everything else. And if you guys have any questions, you can always give me a call, 239-980-2792. Hang in my cell phone out there for you guys to call if you are interested in a one-on-one talk about this. Give me your insight, even if you want me to maybe look up your area, because I'm very focused on Southwest Florida, but know that this data exists and I can get for any city, state, even down to zip code, and be able to actually make one of these things for you. And of course, you can email me too. I look forward to hearing from all of you. And if you like this video, you made it all the way to the end, like, subscribe. I do send these out, and I will start doing more and more videos, little 5-minute ones, maybe instead of going over all these things. So I can keep these videos short, keep this more of an overview, and then do little videos as things happen. Hope to hear all from you soon. Thanks. Bye-bye.